So let's talk about Monday and what you saw this week.
Yeah. So look, last time we chatted, and we've had a consistent story since we've been chatting with you throughout the course of the last couple of years, is we were very bullish early on since 2018, but over the last, call it 6 months, we've started getting very cautious because of what we view as the 4 year cycle reset, or the contraction phase in the business cycle, is what we saw on the horizon. So just so you know, we put out our outlook piece December 31st, or I think it was January 3rd, just saying, hey, look, our target this year is actually 4250 on the S&P 500, which was 11% downside from the January 31st close. We had the lowest target of anyone on the street, and lo and behold, we hit it in the first 3 weeks. So this is not over. This is not done.
Hi, it's ggoernert, Senior Investment Advisor, Canaccord Genuity Wealth Management and ggoernert Wealth Management. Now, welcome to the channel where we help you make sense of the financial world. Now, as always, if you like our content, please like, share, subscribe. Throw a comment down if you want to see any other topics discussed. Now, next week coming up, we're going to have Katie LaChapelle talking about her uranium outlook for 2022. But today, and this has been on short notice, and I really want to thank our guest today for joining us, but it's been a wild week in the market, so I really want to have Javed Mirza, Canaccord Genuity technical analyst, join us today. Javed, how are you?
I'm doing well. How are you?
I'm doing really well. Now, hey, once again, thanks for doing this on such short notice, but it was a wild week, and we had Monday, the Dow off, well over 1,000 points, and then finish in the last, half hour, 45 minutes,
Yeah, a bit of a
bouncing
rally.
around. Yeah, so can we talk a little bit about that? And I want to put that in the context of your sentiments, and you were talking about being oversold, and maybe this is the counter trend balance of your 4 year cycle reset. So let's talk about Monday and what you saw this week.
Yeah. So look, last time we chatted, and we've had a consistent story since we've been chatting with you throughout the course of the last couple of years, is we were very bullish early on since 2018, but over the last, call it 6 months, we've started getting very cautious because of what we view as the 4 year cycle reset, or the contraction phase in the business cycle, is what we saw on the horizon. So just so you know, we put out our outlook piece December 31st, or I think it was January 3rd, just saying, hey, look, our target this year is actually 4250 on the S&P 500, which was 11% downside from the January 31st close. We had the lowest target of anyone on the street, and lo and behold, we hit it in the first 3 weeks. So this is not over. This is not done. We have more choppiness, more volatility, in our view, up ahead for the next 6 months. The good news is that in our view, this is the start of what we believe to be a new 4 year cycle. So if you take a look at my arm here, you can kind of see this is like this secular bull market that we see
Yep.
going out to 2030. But within that secular bull market, you have these like a sine wave, like these expansion and contraction. And right now, we're simply in the contraction phase. So this is what we've been warning investors about over the course of the last couple of months. Here we are, more volatility, likely potentially out to U.S. midterms. But the silver lining is that there's going to be a new cycle starting at the end of this year. So that's what we're really excited about.
Yeah, we saw that. Now, just investor sentiment right now, we got to, very bearish sentiment. Are you seeing, we might be looking at, kind of a short-term bounce over the next little bit here, and is something that's tradable, or what are you thinking on that side going forward?
Yeah, look, what I'd be focused on here for investors and for your clients is to be adding exposure to high quality, proven companies here. So I don't mind nibbling here. And our view is that we're likely to have a bit of a bounce over the next couple of months here. And then we're likely to see some sort of retest of these lows. I don't know if it's going to be a marginally higher low or a lower low, but we have pretty high conviction that there's going to be a retest over the course of the next couple of months. So that's our primary scenario. What we could see is that the low is going to happen over the course of the next couple of weeks. And that, of course, is if we just get further downside, like in the course, roughly call it another 5 to 10%. If that is the case, if that's the scenario that plays out, then in our view, we're going to see a major low here, and it's going to offer a really attractive longer term entry point.
Yeah, and that's a good point too, because I mean, there's a lot of reasons where the market's going to be looking for reasons to sell off. I mean, you're seeing temper tantrum perhaps on the on rate increases that are probably coming forward. Maybe we're seeing something on the geopolitical front that might give an opportunity for investors. My sense is that the market's looking for a reason to fulfill what you're talking about there. But the fundamental thesis that you've got is that going forward, we're still in a bull market, but it's nothing goes straight up, and it's healthy for things to move back down. Last time we had a big sell-off, was back in the early days of the crisis of 2020. In my experience, on average, every 10 years or so, we have a major financial crisis of some type, be it the financial crisis or the dot-com bubble or whatever. And in the meantime, every 3 to 5 years in the middle, there's a minor kind of crisis that leads the market to sell off. Do you think we're kind of there at that point, using that analogy, going back to, I'm thinking 2008, in 2010 we had the Greek debt crisis, and that was an excuse for the market to sell off again. Is it that kind of situation?
Sort of. So,
Yeah.
what I would say is our work puts the cycles much more clearly into perspective. So,
Yeah.
we were anticipating this 3 to 5 year correction, and in our view, it's unfurling right now. But it's not necessarily that you have this bigger corrective phase every 10 years. What it is like I said, when you're in a secular bull market, typically those last 20 to 25 years. The last one we had was from the 1980s that culminated in the tech bubble, and then from 2000 to 2010, you were in this narrow box,
Yeah.
and that was a secular bear market. So effectively, a lost decade, and that saw the 2000 bubble and then the 2008 financial crisis. And of course, we're continuing to push higher from the lows from that financial crisis. But like I said, I think the next big next secular peak is going to occur somewhere around 2030.
Yeah, yeah, and I want to be clear when I say that, that's just my thumbnail that I
Yeah,
express to
of
people.
course.
Yeah. Now, interest rate rises, growth stocks. What are you feeling on them? Because those are the ones that have been hit the hardest. And then I want to talk a little bit about any thoughts on the Canadian market versus the U.S. markets.
Yeah, so I can touch on both of those. So first off, we've obviously, and this is what we've been talking about in our notes since the fall, is that we're seeing this rotation out of growth and into value. We've been highlighting, I think last time you and I chatted, we were talking
Yeah.
about energy and financials, and those have continued to work. But a lot of clients have been asking, hey, is this a big secular shift away from growth and into value? And our view is definitely not. We think this is just part of this correction that we're seeing through the market cycle model, and into this contraction phase of the business cycle. In regards to the Canadian market, look, we're very bullish over the last couple of years on Canada. And the reason is because materials, as you get into the late
Yeah.
cycle on this, I shouldn't say materials, I should say resources, materials
Yeah.
and energy. Energy is a late cycle play. That's why energy has been a superstar up till now. But as we get deeper into this contraction, energy is going to peak out. And our concern is this is going to be, I think this Canada could outperform this year just because of the big weighting in energy, but or at least for the first half of the year. But as we get into the second half of the year, where we think the market's going to bottom, and where we think you rotate back into the growth areas of the market, so a lot of these broken down growth names, then I think Canada is going to underperform, probably from, call it 2022 to 2024.
Right. Okay. So, but you're still on. Yeah.
It'll still go up, but just not as much as the U.S.
Right, right. Now you touched on resources, X of energy as well. Any thoughts specifically on the resources?
Yeah, so I mean, one of the things we highlighted in our outlook piece was we think the golds are interesting here. Golds actually do pretty well during a Fed rate hike cycle, and if you look at our work, our quantitative work, a lot of the gold equities have been beat up quite a bit over the course of the last year and a half, so their valuations are quite attractive. It's funny, we're in the midst of meeting with institutional clients, and we were walking one of our institutional clients through the fact that gold stocks right now look like energy stocks did a year and a half ago.
That's interesting. Interesting.
Yeah.
Hey, why don't we leave it there? Once again, thanks for the short notice on this. It's been an interesting week on the market, and come back and join us. Look forward to seeing you in a couple months. Javed Mirza, Canaccord Genuity, technical analyst. Javed.
Awesome.
Bye, Javed.
Greg.
Thanks for watching. If you want to see more content like that, please consider subscribing or join me on my website, ggoernert.com. That's ggoernert.com. Look forward to seeing you there.